Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagerin. Hey, Doug.
Hey, Kirk. Happy Friday to you. Hope you're doing well. Spring break for many people out there. So wherever you're doing, hopefully many of you work really hard. So hopefully you're spending some time that's quality with your family in this upcoming week or weeks, depending on where you are on the schedule.
Yeah, I feel remiss because we didn't have a St. Patty's Day episode, Doug. You
We did
know,
not. We didn't have a St. Patty's Day episode, but you and I were talking about this offline. I think it was you, but it was a weird St. Patty's Day. It felt
yeah,
very, almost like it just came and went.
yeah. There wasn't as much celebrating as normal. Normally, people are up and all celebratory and all that, and I think we talked about this last time. Probably Boston takes. Oh, maybe it was you. Yeah. So Boston. We're a funny city, a lot of Irish historically, and so we don't celebrate St. Patty's Day in Boston. We celebrate Evacuation Day, and
Cool.
Evacuation Day is when the British left, and so that happens to fall on St. Patty's Day. So they declare a state and certainly a city holiday, so everyone gets the day off, so they can go start drinking where the pubs open at like 8 a.m. or 6 a.m. or wherever it is, because the drunks really need to get into the pub at early first thing in the morning. And anyway, some people drink all day into the night, and it's a fun event. But I didn't hear much about it this year. It was weird. Maybe because I'm not living in the city anymore, I'm just not hearing about it. But it was just kind of a weird quote unquote holiday, a Massachusetts holiday. But anyway, we'll try to celebrate Cinco de Mayo because that's coming up. So anyway,
I got a fridge full of chorizo, Kirk. I'm ready. Let's go.
All right. Well, we'll do it right. So I want to talk about a few things. We talked about the housing bubble last week, which is starting to pop in certain areas. I did a little more digging and saw Massachusetts is up like almost 6%, and other states are down like 10. So I think Massachusetts is going to keep on trucking, fortunately or unfortunately. Massachusetts is in its own bubble, as we always tend to be. But another thing I want to talk about last week we didn't get to was valuations, and I want to talk about this because Barb and I were talking about this in one of the recordings this week, which will come out later. But if you look at the PE, the historical PE is around 17. If you look back like 50 years, it's around 17. If you look at it now, it's like 35. And I only point that out because it's, depending on the metric you look at, it's one of the most expensive markets that we've ever had in modern history. And it's rivaling the tech bubble, which, depending on the metric, some ways it's more expensive, some ways it's less expensive. Even after it's sold off 10%, it's still pretty expensive. So I wanted to point this out, and I wanted to just do some simple math for everybody. If you look at, let's say the PE is 36, right? What is half of 36? 18. So 35, half of that is right around 17 and a half. So if you have a PE of 35 and it gets cut in half, so if the stock market goes down 50%, then the average PE would be 17 and a half. So by historical standards, we are double what the average is. So if we lost 50%, it would be historically in the average range of valuations. When Barb and I were talking about, like, that can't be true. So if the stock market drops 50%, we'll be normal. That's crazy. It's crazy to think about how expensive the market really is. Now, I mention this for a few different reasons. One is because I don't think people really understand how expensive it is. People talk about it, and we've been talking about it on the show for years, but I don't think people truly understand how expensive it is. So that means that basically the stock market, to stay within this valuation, we have to be growing like 100%. The earnings have to grow like 100% just to stay with where we are. There's no way that's happening. And we're going to talk about in the show about stagflation, because that's something that's creeping it, sticking its head out. It's going to be a mess. And I think one of the challenges that we see is we have since 2009, the markets have pretty much just gone up. You look at 2020, the whole world shut down, businesses stopped, people were shuttered in their homes. Everyone was afraid to go outside because they were going to catch scabies or whatever, a COVID bug was going around. No one knew anything, so you're afraid of everything. And yet the stock market was up that year. It was up like 7%. It's crazy. And so we have this economy, we have the stock market where people are not afraid. People need to be afraid. Risk is real. And because we're not afraid of the risk, people just ignore it. And what happens when that happens, and I've been around the block a few times to see this, the tech bubble was another example. People just ignored risk. They're like, yeah, I know it's expensive. I know these companies don't make money. Whatever. I'm putting all my money on this tech company that doesn't make things. And people did that and they lost tons and tons of money. And it had been a long time since people experienced something like that. And so when it happened, smart people were like, I'm out of here. And dumb people were like, yeah, I made 100% last year. Let's do it again. And they lost a lot of money. And the NASDAQ was down like 83% or some crazy number in subsequent years. So I only point this out in historical context because if you don't understand history, you're doomed to repeat it. We have a whole generation of people, and many of them are market professionals that have never seen bad times. Never. It's been since 2008, which is what? We're looking at 17 years? About right, Doug? 17, 18 years?
So, yeah, incredible amount of time. A full generation that are now well into their 30s that have started working, that have never, ever seen risk. And I think that's led to the height of, if you go on social media, people are like, just throw the money in the S&P and it's good. And if you do this, you're guaranteed to have $1 million. And then you go back and reverse engineer. It's like you're using like 8, 9, 10% every year calculations to tell people what their money's going to do with no awareness, no discussion of risk whatsoever.
Yeah. So think about it this way. I had a conversation this week with a client, and she was telling me about her kids. Her kids they're pro indexers, right? All the young generation. Oh, we just index. Active fund managers are useless. I'm like, okay. And we talked about it a little bit, and she's old enough to remember the bad times. And we talk about it. It's like, look, what do you want to do? And I'm using this as an example for all the listeners, because the one thing that the stock market is great at is humbling you. Whenever you think you're on top of the world, that's most likely when you're going to get humbled by the stock market, because you think that you've got everything going on, and then it just changes and it'll totally sideswipe you. So the smart people know this, so they never extend themselves too much, because they know it's only a matter of time before they get cleaned out. So they don't extend themselves. They just keep doing what they're doing over and over again. Here's the thing. If you're 30 or younger and you've never seen a bad market, you've got two choices. You can either keep putting all your money on black and just saying, we're going full steam ahead. Maybe the party keeps going another 10 years. I don't know. I have no idea. And maybe you do that and you say, I was right. I was smart. I'm an indexer. I'm going all in. I'm making lots of money. That's one scenario. Scenario number two is you put all your money on black and then the market drops 50% and you lose half your money. You're probably going to sit there and say, well, it'll come back. Okay. Maybe eventually it will. In Japan, in 1990, beginning of 1990, the stock market dropped and did not come back until I think it was last year. So it was basically like 28 years where the market went down. Can you imagine your portfolio dropping 28 years in a row? Or not in a row, but the trend was down. Some years was up, down, but basically it was over a 28-year period. Could you imagine losing money over 28 years on top of the fact there's inflation? Could you imagine that? I can't. I at some point I'd be like, all right, I'm done. Put all my money in CDs and I'll just wait it out. The problem is in Japan is you're actually getting negative returns for your CDs. So it almost forces you to be in the market. Anyway, Japan's a crazy place. Point being, though, there weren't a lot of places you could put money. Basically, cash under your mattress or gold. There wasn't anywhere else you could put money. So here's the lesson. So here's what she and I talked about. There's a lesson to be had here. And the lesson is, at some point in time, you're going to pay the cost of admission or the pay for the cost of education. And the education is the markets don't always go up. And you're going to learn that lesson by losing a lot of money. Now, it's best if you learn that lesson when you're young and you say, well, I'm never doing that again. But if you're 60, 55, if you're somewhere between 50 and 65 years old and you have 60, 70, 80, 90, 100% of your money in equities, you should get your head examined because you are going to get your lunch money stolen from you so quick. And all that big pile of cash you have for retirement is going to disappear really quickly. So if you're in that position, reassess what you're doing, take a huge amount of risk off the table. I'm not giving you financial advice. Do whatever you want. I'm just saying how I would handle it. And right now, we're really conservative in our allocations. And I know people that are really aggressive, and I feel for them. They're going to have to learn a lesson. At some point, you'll learn it, and you'll say, I'll never do that again. And you'll learn the lesson. It's going to be a very expensive lesson. When you're young, it's a cheap lesson because, yeah, you maybe you lose 10 grand. Okay. You make that up pretty quickly over your life of saving if you save well. But if you're losing 100 grand, 500 grand, $1,000,000, 2 million, because you're really aggressive, that's a really expensive lesson to learn. I would not want to learn that lesson. So be mindful of the risk you're taking. And we are in a precarious time, which, like we said last week, you have to be able to separate the politics from the economy, from the stock market. Those are three different things. And whatever your opinion is of Trump, disconnect it from the stock market. Whatever you think of the economy, disconnect it from the stock market. They are not all the same. Actually, they're not even close to the same. They're completely different things. So you can have a strong economy and a weak stock market. You can have a strong stock market and a weak economy. You could have political chaos, or you could have political unity. Either way, it won't. It may impact the markets, but it's not the way you think. So anyway, try to disconnect your emotions from all that. And just try to remember, like we are in a tough time. So we're not there yet. People feel good about Trump, and some people are freaked out about Trump. I know some people that are trying to leave the country. I know some people that are celebrating about him winning. Anywhere in between, it doesn't matter. We haven't seen the effects of much of what he's doing yet hit the economy, but we are starting to see stagflation. We're going to talk about a little bit about that, but I do want to point out the valuation measures, because if you're not thinking about the valuations, if you don't have 1 foot out the door or 1 foot on the brake or some way to hedge yourself if the market crashes. By the way, I don't expect it to crash, but I do expect it to have a 2000 to 2002 kind of downward slope. I do expect the markets to be down 30 or 40% in the next 2 years. That is a very strong probability in my mind of that happening. And I don't know when it'll happen, but I do expect that could very well happen, and we're prepared for that. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money. Doug, what are some of your thoughts before we jump into some of the charting here?
Well, I think, I just had a conversation with someone a couple days ago where, we were looking at a combination of both highly appreciated assets with regards to stock, or taxes and embedded taxes, and trying to figure out how to deleverage that, but also a philosophical belief, and I would argue this maybe a little bit of a fear-based belief, that, and it came down to, the response being, I'm kind of, well, I don't want to get, reduce. I don't want to eliminate the stocks that I'm holding. And they don't, I don't understand why I'd remove those stocks, because, I've done they're obviously doing well and have done well. And that evokes obviously, clearly a belief that will continue indefinitely. even with a response that was given to me about, I'm counting on those returns. I've done those calculations, which again, if you take a look at, a lot of what's being communicated out there, and this is not someone who has not gone through a pullback. This is someone who's gone through pullbacks before, but the further we get away from it, the more we forget what happened. And the reality is that future returns are uncertain, especially when valuations become elevated. You mentioned the 50% decline. Absolutely. If you go from a 35 PE to a 15 PE, you are looking at a nearly 50% decline, even if earnings remain stable. And then you look at clear historical situations like the dot-com crash, 2008 crisis, recent tech corrections. I mean, right now I actually was taking, looking at, and even crypto, right? And again, now crypto seems to keep pushing back there, but depending on when people got in, some people are still significantly hurt by the volatility that's occurred in crypto and tech corrections, which can illustrate the danger of blindly chasing returns without regard for fundamentals and risk management. Looking at what is happening recently, there is something that we talk about, not we necessarily, Kirk and me, but is mentioned in the industry. And I don't want to call this out other than using the terms that are being used, which is smart money, and then kind of, which is more institutional. And then you've got retail, what they call FOMO, or fear of missing out, dumb money. And recently they've diverged significantly. The institutional investors have reallocated assets towards safer investment instruments. There's been a substantial influx to short-term U.S. government debt. $22 billion has been directed into short-dated treasuries. And that does reflect a cautious stance amongst concerns over economic policies and market volatility. There's also been a diversification into more alternative assets. So smart money is adding in, infrastructure, private debt, private credit. Those have been gaining traction. We're going to talk about it a little bit more. We've seen a rotation out of maybe, just by the S&P 500. We started to see a rotation that has shown international has done better lately. But data centers and airports have actually shown that they've been more attractive too, because, listen, there's a lot of support outside of growth cycles. So they tend to be fairly resilient historically. I mean, planes are coming in and planes are going out. Now there might be less planes going in and going out, but these airlines can't give up their parking spots or they'll lose them forever. So they're going to pay the rent there either way. You've seen more edging with gold recently, increased allocation as a safe haven asset. Now we're not saying, we've seen gold prices reach, record highs. Now let's look at the counter to that. What's fear of chasing out? What's dumb money been doing? Well, retail investors have, there's a lot of this just buy the dip, and they have a tendency to buy shares of companies experiencing significant downturns, not wanting to miss out, despite Tesla dropping by 50%. Now, do I think it's going to come around eventually? Possibly. It may get to a point where it is truly a great deal. But recently, with just the dip it's already had, and it continues to, retail investors purchased 7.3 billion shares over a 12-day period, reflecting that buy the dip mentality. You're seeing a notable decrease in cash holdings amongst retail investors. So, when Kirk say, look, I think the next year we might have 50, 60% decline in the markets. Again, as I've said before on several of these, there's a difference between buying low and selling high, or being able to be opportunistic, which say Warren Buffett does, and he's sitting on a ton of cash, and buying the dip. If you don't have the cash holdings to be able to be opportunistic, you're not going to be able to take advantage of that. So there's actually been an increase, you could argue, in aggressiveness recently on these equity investments, and chasing short-term gains, exposure market volatility. And I'll leave it with this: the last comparison, there's been an even higher overexposure to risk assets. So the things that are continuing to get higher and higher PEs, just like this conversation I had, there's that feeling of, but look, that's where it's making money. And this goes back to a very common pattern of, I don't want to put money in things that could come up. I want to put my money in things that are already up. And that's a high risk, high reward strategy to speculative or volatile sectors or things with higher PEs without adequate diversification. And that can heighten significantly vulnerability to market corrections. So right now, if you don't want to listen to us a little bit on this, we're already seeing a significant divergence between institutional money and retail money. And I will say this, historically, guess which one wins more often? It is going to be the ones that were proactive. They have a, historically, there's been a barrier to entry for retail until more recent years. So retail investors, as we've seen with some of the things, some of the stonks, have had more influence than ever on stock prices. So they're gaining traction on the ability to move the markets. But yet there is still significantly more money on the institutional side, significantly more ability and teams to be able to analyze data. And as I said, we've said before, Warren Buffett's sitting on $380 billion right now when there's a lot of money to, you could argue, to be made by just chasing those really great stocks that have done so well for the last 10 to 15 years. But there is a belief, and those with money are preparing, not because they're scared. I want to make sure that I'm very clear. It's not fear-based. It's opportunistic based. It's, I want to know that, yeah, I have some exposure, but I'm going to trim that, because guess who gets to jump in and gets to take advantage of those that have built up that flexibility. And the only way to do that is to understand when to trim. And this might be one of those times.
Yeah. So I want to dive into some things I didn't have time to talk about last week. And one of them is international markets. So I want to point out this chart because I think this is 2 weeks old, so the returns are a little bit different. But I want to point it out just from a general trend perspective. So the U.S. markets have been the hot place to be for the last 2 decades, and typically there's like decade U.S., decade international, decade U.S., decade international. It's been going like that for a long time, but for the last 2 decades, it's been U.S. only. Like everyone's doing U.S. and nowhere else. And what's interesting is, I mean, China's had its ups and downs. When they were pro free markets, people were investing there, and as soon as they were anti free markets, people left like rats from a ship. And so I've always been a little wary of China because all they have to do is say something stupid, and then the stock market crashes and everyone pulls their money out. So I really have no interest in China. But there are other international markets out there. Japan's had a few good years, and if you look at Europe's actually done great this year. I think Europe's up somewhere between 15. If you look at this European index, it's 15. I think Germany's up 20%. Somewhere there, it says here 23%. Spain's up 22%. China's up 21. So there's some countries that have done extremely well this year, and the U.S. markets are down. I don't know what they are today, but they're down somewhere around 8-10%. So if you look at, in comparison, most people are U.S. centric, and this actually is very common with any country. So if people live in Germany, they tend to be overweighted in German stocks. If people in the U.S., they tend to be overweighted in U.S. stocks. And Japan, the UK, and all these other countries tend to be centric, with their own country because it's invest in what you know. Totally makes sense, but it's not healthy in the bigger perspective. So for all those you who are investing 100% in the S&P, or going all into the Mag 7, you're going to be in trouble, because this year may not be one of those years where you get paid to be in the U.S. So far, you've been paid very well to be in Europe. Now, people could speculate, well, this is because they're going to end the Ukraine war. Okay, you could be right. But, how much the Ukraine war is really impacting these other countries? Not much, right? It's not really impacting them. Now, maybe the people on the border who are getting a missile land in their backyard, okay, maybe you're getting impacted. But as a whole, these other countries are not really being impacted in a meaningful way. Yet, as soon as Trump gets inaugurated, all of a sudden they're going up. Now, this is contrary to the common opinion, which is, well, Trump's going to tariff people, so the U.S. will do better and these other countries won't. That's not what's happened. If you see here, it's very clear Europe is doing very well in comparison to the U.S. So are emerging markets. Pretty much India's not, Argentina, Saudi Arabia, Taiwan, and Israel and Canada are kind of like flat. Australia kind of flat, but Mexico's up 10%. The UK, which I would say there's not a lot of great stuff going on in the UK if you hear people who live there, that's up 12%. So if you look at international markets, you have to bow down to the fact that they could be experiencing a bit of growth. Now, I've heard this for the last 10 years where people are like, international markets are doing great this year. This year is going to be the year. Europe's going to do great. They're undervalued. I've been hearing that for 10 years. It could be the year, but for 10 years, people have been wrong. So maybe this year they're right. So if people are like, I told you this was going to happen. Yeah, you've been wrong for 9 years. The 10th year, you happen to be right. That means you're wrong. So, point being is you should open your mind up to the fact that Europe is another place to invest. And they might do very well this year on top of what they've already done. So you should be mindful. You should have international exposure in your portfolio. This year is a good reason why you should. And just be mindful of that, because I think if we look at this year, and Doug and I are going to talk about this a little bit, this year we've got, let me see if I can bring it up here. There could be very few places to hide. Like if we experience a sell-off, so like we just talked about, if the markets go down 50%, they're on the historical average. Now my prediction's 30 to 40% drop in the next 2 years. So if that's the case, where are you going to hide? Well, it's not going to be in equities. It could be, but probably not. Where else are you going to hide? Well, it could be bonds, but if bond yields go down in price, then it's going to be hard to hide there. International could be a good place. Right now, from what we're seeing, gold has done extremely well, but commodities as a whole, not doing great. Cocoa prices, thankfully, are continuing to go down. Orange juice prices, which have been dropped crazy this year, seem to have bottomed out. But, if you kind of go around the horn, like coffee's still high, lumber's still high, sugar's low, grain prices are low. There's a lot of markets that are all over the place. Historically, commodities should do well in an inflationary time period, but not necessarily. We're looking at potentially a stagflationary environment, which if that happens, you better listen to the show a lot, because most people don't understand inflation, deflation, or stagflation. We understand it very well. I've done a lot of studying on it, and it's one of the things that I know very well. But I can tell you that I go back to this all the time on the show. We talked about this, the paradigm shift last year that we talked about. A paradigm shift, one of the things that marked the 70s, the last time something like this happened, was mass confusion. People didn't understand what's going on. And you think things are going great, and then they turn. You're like, what happened? And then they go really bad. And you're like, and then they start to turn again, and you don't know which ends up, because it's not clear cut like it has been in the last 30 years. It's different. It's a different environment. It's a different market. You can have massive ups and downs, much like the aughts, like the 2000, 2010 period. You had lots of ups and downs, but it basically went sideways until 2013. That was not the same, but that's the same outcome you might get in the next 10 years. So you have to ask yourself, what are you trying to accomplish in the next 10 years? If you're just putting it all in black and assuming it's going to keep going higher, you might be incorrect. You might want to be a good stock picker, or you might want to find a better solution that doesn't involve you assuming that the market's going to go up every year, because they don't. So, Doug, where do you want to take us? We got lots of charts to discuss today. We got some chart crimes. Where do you want to start?
Yeah, well, one thing I wanted to just kind of add into it. So there's a chart that we have where it shows year-to-date returns on the international. The Morgan Stanley, forgetting what the C is in it, but the MSCI, which is the international index for Morgan Stanley, with USA included, is down 3.34% year-to-date as of around March 12th. The MSCI World excluding US is up 7.52%. So right there, and this divergence really started. They were kind of lockstep until right about the beginning of February, and so since then, that's when they really broke apart. So this run on international has been about just about over the last month. But what's interesting is that is a 10% degrade of the valuation of that index. just all because of US. So I thought that was that's interesting. Just kind of look at that breakout there. And I also wanted to add, and again, this is not for speculative purposes because there's a lot of volatility, and whenever you're investing somewhere, political climate has a lot to do with it. And I'm not talking about do we like the Republican or Democrat. I'm talking about do we think that the government could collapse. But the fastest growing economies in 2025, based on real GDP growth projections, it is interesting how much of that, of course, is in third world countries, which again have more upside, but how much of that's actually located in Africa, South Sudan, Guyana, Libya, Senegal, Palau, which I think that one is actually, if I'm not mistaken, that one might be in Asia. That is. Then we got Sudan, Uganda, Niger, Macau, Bhutan, Mongolia. I mean, it gets down to probably about the 15th is one that the majority of people that invest would have put some money in, and that's India. India's GDP growth is expected to be 6.5% year to date. The rest of these are smaller companies that, typically don't even end up on the radar from investing. Just kind of shows you to where, gives you an idea of where money or where opportunity and growth is. As I said, I'd be very careful because, again, they might have the fastest growing economies. A, where are they starting from? And B, what is the political stability of those countries? I mean, a lot of those have dictatorships and monarchies and things that could go any direction at any time. I mean, we've seen, just for example, Libya is on this list at number 3, and it was one Arab Spring and boom, Gaddafi was overthrown. So, just something to note there. But again, international is definitely having its moment where it's finally starting to kind of make up for years of basically being in the basement. Not only international as a whole, but emerging markets were some of the great, you go back to the odds. If you go back in that time, emerging markets were the absolute darling. Some people are familiar with we call the investment quilt, and that just basically looks like a patchwork of what the best performing asset classes are year to year. And a lot of times what's best ends up being kind of what's worst. What's interesting is that during the aughts, if you look at it, emerging markets was number one, like I think something like 7 out of 10 years. Don't quote me exactly. It was incredible the run that it had. Well, everybody said you got to have more emerging markets in your portfolios. Well, what's happened since the aughts? Emerging markets has been a consistent underperformer. Couple years here and there, it popped up a little bit, but it's been a dog since then. As is all of emerging or all of international, and developed international has kind of been meh for most of those 25 years. So the fact, like you were saying, Kirk, now that it's breaking out, well, great. But how long did that take to actually get there? So if there's a software, I'm not going to name it, but the software was built to take portfolios, analyze for volatility, and it actually had a feature where you could click a button to optimize it. And it would optimize every one of the portfolios that I would throw into it to be 100% international, because it always saw international as the best potential risk return. But as we know, over those 25 years, that never actually happened, right? So the opportunity was there, but as we've said before, what the markets do doesn't always line up with the math. Bonds are math. Markets, very emotional. Hence the FOMO versus smart money I was talking about.
Beware of advisors trucking out technology as a solution.
What was that?
I said, beware of advisors selling technology as a solution for your allocation problems.
100%.
Not the first time I've seen that happen.
There's your proof right there. I wanted to come back here, and I wanted to also, for fun, since we said we were going to talk about chart crime, we haven't done a chart crime in a while. So why don't you go ahead and pull up the one that we have here. Congratulations on the worst performing companies of the S&P 500. And you look at that and you say, wow, man, Carnival, Key, Citi, look at all these financial institutions. Look at, even down there, they've got Intel, but Intel is still up 2%. This one I would call a light chart crime because they're not really throwing in inaccurate information. But as we've talked about before, a lot of times with charts, it's all about what are you trying to capture and the point you're trying to make within the parameters of the time frame. And what's interesting is they used 2005 to 2024. Well, how come why do you think they used 2005, Kirk? What was the point of that, to use that specific year It's because, I mean, granted, it's
Coincidence, Doug.
coincidence, pure coincidence. Or could it be for shock value, they wanted to include some of the most impacted corporations of the Great Recession, which, as we talked about, is now going on almost 20 years ago and really has very little to do with anybody investing today. As a matter of fact, most people investing today never lived through it. So, or at least a large proportion of people in their working years never lived through it. But AIG down 11.4% during that time. Now, I did not have an opportunity there to counter this to look at what AIG's done, say, in the last 10 years, or Citi's done in the last 10 years. But what I can tell you with pretty good confidence is that almost all of those returns happened in 2008. AIG was the company too big to fail, right? It got bailed out. So yeah, going from one of the largest reinsurance companies in the world down to almost going insolvent because of backing up the major crisis certainly would have had a tremendous impact on its long-term return since 2005. But if I had to go back and look since then, my guess is AIG stock, especially considering it got saved and therefore had basically all of its problems removed, has probably done exceptionally well. Now, the other one I would look at here is Intel, because what's interesting is you look at that and say, well, Intel was up 2%. Yes, but Intel was the darling of Wall Street for a long, long time. What was the CEO, Kirk, that was the head of Intel forever, and he was quoted all over the place. Trying to remember his name. But, you know, when you think of the great celebrity CEOs, was considered one of the geniuses, and he was quoted everywhere.
Well, Gordon Moore is the one that started in 75. I assume you
no. This was back in the 90s and 2000s. Trying to remember the CEO that really took him to new heights.
I'm looking at.
But Intel, go look up Intel stock over the last couple of years. It's a disaster.
Andrew Grove.
Thank you, Andy Grove. Andy Grove was. You saw his name quoted everywhere. He was considered probably the greatest CEO in industry for a long time. Now, granted, he retired, and Intel's outlooks have shifted since then. But so is the entire market and economy around that. So again, I guess my part on this chart crime is why? It makes no sense. And it has absolutely zero bearing right now on where you should be investing today, or where you probably should have had your investments over the last 5 to 10 years, which again is when the majority of people that are listening to this would have been investing. So I don't know. To me, it's useless. I mean, congrats. Well, so
anyway, great chart crime there.
Great chart. Go ahead. Yep.
Yeah. So we talked a little bit about the rotation from U.S. to international. Certainly that's going on. I'm not sure if it's still going on, but it's certainly international seems to be strong, especially in Europe. But I also want to talk about a few other things which we missed last week. So Trump did sign a executive order declaring Bitcoin as a reserve asset, and this has been widely talked about as happening, and then it did happen, so it's not surprising. And a lot of people were shocked because what happened after? The price of Bitcoin dropped, and most people thought, well, it's just going to go up. Well, I point this out because I think what tends to happen is people miss out on the fact that they don't understand how markets work. So if you're speculating that something is going to happen and you can't wait for that thing to happen, when it does, it's just going to go through the roof. Well, here's what happens. Everybody else has already made their bets on whether that thing's going to happen or not. So once it happens, people remove their bets. So if you think of it this way, so let's say ABC company is going to release earnings tomorrow, and I bet that they're going to disappoint, and the market and the stock's going to go down. Doug bets that they're going to do really well, and the stock's going to go up. That's what makes a market, right? We have people on either side of the trade. But once the news comes out, whichever one of us is right, so let's say Doug's right and the market goes up, then once the news comes out, I sell my position because I was wrong and I'm going to move on. Well, Doug also sells his position because he was right. He's going to move on. And so once the news comes out, it's over. Like, people are not speculating on that news anymore. They're speculating on something completely different. So if you look at like the history of Bitcoin, if you go back and look, typically the high points were periods where some really good news happened, and then all of a sudden, all right, the news is out, and then it crashes. So I think the news, one of the peaks of Bitcoin was when Coinbase went public, I believe. Um, I think that was one of the peaks, and another
Yeah.
peak was, after the Bitcoin ETF was launched, which is, I always find funny because there was already a closed-end fund you could invest in, so it wasn't like you couldn't do it already. But somehow, all of a sudden, it's just going to make things better. I totally didn't get that. But anyway, so you saw a little sell-off after that. And certainly, we've seen a little bit of sell-offs from the peak. It was up to 110,000, I think it hit, and now it's down to like 84,000. So I only point this out because it's a good example of how markets work. It so happens that Bitcoin is an extreme example because it moves so quickly, but it's basically how markets work. Once the news comes out, it's over. So there's a strategic reserve coming out, or that they've announced that we have a strategic reserve asset of Bitcoin, but it also includes other cryptocurrencies and shit coins, as they're called. They basically said they're not going to sell them. Well, these are confiscated assets from bad guys that the U.S. government has confiscated, and now we're just going to sit on them. There's going to be a pile of these things, and they're ours. They've just said we've declared them ours, and that's just the way it is. I don't know what that's going to entail. I don't know if that starts an arms race with other countries trying to grab their own. I don't know, but it is very interesting. Um, and I do find it interesting to see that we have such a large portion of it that we will never buy or sell, um, according to what they've said. Although they did reserve the idea that they could buy more Bitcoin. They did say that could happen, which I find to be an interesting thought of whether that's a good idea or not. I don't have an opinion, but it's interesting because that will be a long conversation with a lot of people of whether we buy more. Um, I don't think we should be owning the shit coins. I think that's a bad idea. I think, a lot of those are garbage. Meme coins, things like that. They're pretty much just, a speculation. But I do find it interesting. I also have this theory, which I talk to a lot of Bitcoiners that just love it. And my theory is this: I think the U.S. government created Bitcoin in some shadow program that wasn't meant to create it. It was just, they have all these little programs. So the government funds a lot of these little island programs. They say, oh, well, let's try to do this. And they give money and then they fund it. And it's just, it's kind of like a DARPA kind of program, but they fund a lot of these little programs and then they start them and then that's it. Like they either get attention or they don't. Well, what's to say that this wasn't started accidentally and it turned into this thing because they were chasing something else and now it's a big thing? I have this theory that Satoshi is actually just a few people in the government that created this thing, and there's all these bitcoins sitting there that no one's touching because they can't, and they can't reveal it was part of the government, or people wouldn't trust it. I would not be surprised if like 5-10 years later, after it's established and Bitcoin is like the is the new dollar in our country and it's used that way, all of a sudden, oh, by the way, we started this. I would not be surprised at the least to see that happened. I feel like I'm living in a movie sometimes, and wouldn't that be the funniest thing to happen? It would totally throw the libertarian crowd into a hissy fit because that's the whole reason they're in it, is because they don't want to be attached to the government. So I just think it would be pure comedy. But anyway, so let's see here. So we have a bunch of charts here. Bitcoin reserve, we talked about that. Oh, so really quickly, I want to talk about just the markets, and we'll hand it back to Doug to finish this up. So, if you look at where things are going in the markets right now, they're really all over the place. And I'm not going to bring up individual stocks, but I am going to bring up some indexes here just to share. Yeah, so here's basically the Dow, which, by the way, nobody really looks at. Individual investors look at it, but nobody in the institutional world looks at it. It's kind of a useless index. It's 30 stocks. So basically, here's what that looks like. The S&P 500 is more of the index that people look at. So here's pretty much the last year. It went straight up, even though it didn't warrant that. And pretty much in the last month, it's gone more or less straight down. Now, it kind of chopped up a little bit. But I want to point this out because I don't think people realize what's going on in the markets, why they happen, when they do. And so you need to, we'll get into this next week. We'll go into more of the technicals of it. But here's what you need to realize is that we seem to be in this sort of a topping pattern with the markets, which we don't know for sure. We don't know if this is a topping pattern. We don't know if this will be it. And then the markets are going to sell off, or we don't know if this is just a break and it's going to go higher. Now, the perma bulls are saying, oh, buy the dip. Okay, maybe they're right. I don't know. I have no idea if they're right. No one does. Or it could be that they're just, they're buying the dip and then everyone else is selling that and then the market's going to keep going lower. My hypothesis is that we're going to start going lower. I think, I don't know if it's right away, but I think in the next 2 years, we're going to see a 30 to 40% drop. And it would be nice because it'd be nice to be able to buy good stocks that you want to buy at a reasonable price. There'll be a lot of pain for a lot of people, but frankly, that's how markets work. So, I'm empathetic, but I'm also wise enough to know I've been doing this for 25, 26 years, and I know what this looks like, and this kind of looks like we're going to see a topping pattern. So, if we do, I would not want to be trying to buy the dip. So, if the markets start to drop, if we start to see the markets reverse trend and flip this around and starts going negative, you don't want to buy the dip. You want to call what they say sell the rip. So you don't want to buy it as it's bottoming. You want to sell the top. You want to sell it after it goes up. So you'd sell it here and you'd wait and then it drops and then you sell it again and wait till it drops. It's basically the reverse of a bull market. So everything about a bear market is a reverse of a bull market. Now, personally, I just stand aside. I don't get involved with that because it's way too hard to sell a dropping market. I'd rather just wait it out in the sidelines, not make money. Once in a while, you can play around, but generally, I like to just sit in the sidelines because it's way too dangerous for most people to play. And frankly, it's not worth it because if I'm sitting in cash and the market goes down 50%, I just made 100% in my cash. My buying power just doubled. So why do I need to play around? I'll just wait. I'll wait till my cash is worth more and I'll go buy some valuable asset and sit on it and wait till it goes up again. So anyway, just something to think about. If you look at the NASDAQ, it's obviously worse because the tech stocks obviously are a big weight of that and they have not been doing well. Russell 2000 small caps, obviously also not that they haven't been doing well in a long time. So Nikkei has been selling off a little bit recently. Euro stocks recently didn't do as well, but they were doing great beforehand. DAX doing well. Anyway, so Doug, take us home here.
Oh, yeah, perfect. So I was going to say really quickly, it was just a play on what you had mentioned, and again, just for fun, but there is speculation out there with regards to the name of Satoshi can't say it right. Satoshi Nakamoto, is that what it is? I had it here a second ago, and then I got off the name, but you were talking. I thought it was funny because you were talking about the names of some 4 individuals. But interesting, there's a group that has speculated that it's made up of a group of companies behind it, including Samsung, Toshiba, Nakamichi, and Motorola. So that's where they, that's one of the, the speculations that's out there. I don't know if you've seen that, Kirk, that it comes from the name, the breakdown of their names. Also wanted to kind of talk a little bit about, you mentioned the small caps, but also now effective today, it looks like NVIDIA has also seen the exact same thing, but we have actually both small caps and NVIDIA have entered what's called the death cross. Now, that's a technical indicator investing that has historically signaled potential bearish market conditions. And what happens is when a short-term moving average, typically the 50-day, moves downward and crosses below the long-term moving average of 200 of the 200-day. Plain and simple English, could mean weakening momentum and potentially significant downside ahead. It is often viewed as kind of an extra layer of confirmation of a bearish market trend. It's not foolproof. False signals happen. I'm trying to remember there was a death cross on the S&P, I think a couple of years ago, that ended up being meaningless. But it does often trigger increased selling or shorting activity, and it can be an early warning sign. So going back to our risks, I mean, now that we've seen small caps and now that we're seeing NVIDIA, which going back 6 months ago was one of the best performing stocks, but I'm going to come back to that in a second. Consider this a wake-up call and evaluate the risk that's going on and the asset allocation in your portfolios. Don't use this as a trigger to panic sell, but review protective measures, hedging, reducing exposure, okay? Because none of this is a guarantee, but when you start to see a lot of guarantees, like if you smell some smoke, that does not mean there's a fire. If you start to see smoke and smell smoke, it still doesn't mean there's a fire. But I would definitely, increasingly protect yourself as you get further, because eventually there's going to be a fire, and from a fire you could have an explosion. But doesn't mean that's actually going there yet. It just means to take caution. But I want to come back to NVIDIA for a second because I thought this was interesting. There was a list of the greatest declines in the stock market, biggest single day declines. And this one is a list 2, 4, 6, 8, 10. So the top 10. And guess what? Guess how many companies are listed in the single biggest day stock declines that have occurred at least, well, they didn't say how far they went, but this was as of January 27, 2025. So actually, we've probably seen more of this since. Okay, think how many companies show up in the top 10 greatest stock declines, Kirk. I'm going to tell you that you're probably not sure. 3 companies have shown up in that. Now, what 3 companies exist? Well, they're all technology. So if this doesn't tell you, when we think of the Mag 7 and we think of the S&P 500, we think and the Mag 7, I want to come back to that in the S&P in a second. But if you think about what that means and how the S&P has been driven by technology, but the greatest volatility in the S&P that exists of any asset class is technology. And by the way, there's a correlation to Bitcoin, no matter what people think about it and this anomaly that it's going to be for currency and the world changing. It's still very correlated to tech, okay? And that's because it is. On the back end, it's a technology. But guess what? Out of the top 10, Amazon came in once at number 4 on April 29, 2022, and Meta came in once February 3rd, 2022. The other 8 is all NVIDIA. That doesn't tell you. So I thought, bringing that fact that NVIDIA just hit the death cross is something really important. The other thing is I saw something the other day. I want to come back to the S&P because I think this is really critical for people to understand, and they don't. So many people, and again, they listen to Warren Buffett say, the average retail investor should just invest in the S&P 500. And people firmly believe that if you're investing in the S&P 500, you're investing in 500 stocks. Well, you kind of are, but not really. If equal weight, there are equal weight funds out there that do invest equally in all 500 and rebalance. The S&P does not work that way. It is a market cap driven, and by that extension, a momentum driven index, which means that the bigger the market cap of the stock in it, the greater percentage of the S&P 500 it now commands. So one of the great ironies of Tesla out there is that Tesla at one point was the 7th largest market cap stock in the S&P 500. And yet, people are like, well, looking at the billionaires, that actually ended up being about a 3 to 4% impact. Not that it causes a 4% decline in the S&P or growth, but that it impacts, that single stock will impact at that point the performance of the S&P by 3 to 4%. That's why the Mag 7 have controlled so much, because their market cap is so much higher than everything else individually else in the S&P 500. What does that mean? Is that if you're tanking Tesla stock, now that it's about 10th in market cap because of the recent decline, but some of the S&P 500 decline that you may have experienced over the last month, although it does correlate with one of the more volatile months of the year anyway, may have actually been because of the volatility of NVIDIA and Tesla. So if you're out there trying to take down Tesla as a company, understand that has a higher risk of impact on your S&P 500, which again, if that's in your 401k, you're just undermining yourself. So just think about that a little bit for a second, because people do not understand how that works. We've got some other things that we would talk about, but I know we're up against the hour, so we're going to wrap it up here. I just want to, we can come back to that. Understand we got new job market reports. We can talk about those, but job market openings keep falling. So the demand is certainly not there as it was. We've seen, layoffs happening. So that's something we can get into a little bit more later. So Kirk, unless you've got something else you want to say, I'll just go ahead and
just wrap it up.
All right. Well, listen, one of the things, again, inflation, we're talking about stagflation. What is, and actually we got something I'm going to just get into really, really high level here, but we can talk about this more maybe next week or, the next time we talk. But in the 1980s, somebody just did the calculations. It was really cheap to live, but luxuries were really expensive. Not going to get into details.
Yeah.
Now, what was that, Craig?
Let's do it next week.
Yeah. But now luxuries are cheap and life is expensive, the needs. Where does that lead to? It means that if we get into stagflation, we've got a challenge of the things that not the things that we want and desire on the fringe that are expensive, but the things that we have to pay for every day are expensive. And that means food, clothing, water, shelter, and college. And college is something that is going to, if you care about your child and want an extraordinary future for your child, you're going to probably emotionally, and because you think of that return on investment of their outcome, you're going to be going and putting a significant amount of money to get your child into the next stage of the life through college. And so for a lot of families out there that may be lower income, there's actually a fair amount of things. It's expensive. There's a fair amount of things out there to help you. For middle class and higher, for the affluent families, this is actually an area where they get the least amount of help. And that 20% of your time should be focused on getting the cost down through picking the right schools or finding the scholarships that might be available and positioning yourself there. But guess where the best impact you can have is? 80% of the time should be focused on how you pay for college, using strategies that give you tax breaks, making sure you're finding money you're losing in inefficiencies in the way you do things. And a lot of what you thought is true about how to use money, it's untrue. And if that was the case, when would you want to know? So if you want to learn a little bit more about that and just be more, and not waste your money and be more efficient with it and pay for college the right way, start by getting the information. My website, mergentcollegeadvisors.com. That's MERGENT, mergentcollegeadvisors.com. And again, if you are an affluent family who might be able to afford college or, easily or not, this is the most important thing for you, because unfortunately you have the most to lose.
Awesome. Well, thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.